Welcome to the Deep Dive. We dig into the latest earnings calls and updates to figure out what really matters.
Yep.
Today, it's Safe Bulkers, their first quarter 2025 results, and the conference call that went with it.
Exactly. We're aiming to pull out the key numbers, the strategic thinking, really get inside what management discussed.
All based purely on what they shared in that Q1 update.
Precisely.
Okay, so let's jump right in. The numbers for Q1 2025, how did they stack up?
Well, financially, it was definitely a softer quarter compared to last year. Adjusted EBITDA, for instance, came in at $29.4 million.
Okay.
Which is, quite a drop from the $64.3 million they posted in Q1 2024.
Right, a significant difference. And I assume that impacted earnings per share too.
It did. Adjusted EPS was 5 cents this quarter. Last year, same period, it was 20 cents.
Oof. Okay. What about the operational side? Like the time charter equivalent rate?
Yeah, the TCE, that also reflects the weaker market. It averaged $14,655 per day for Q1 2025.
And that was operating how many vessels on average?
Around 46 vessels. Compare that to Q1 24, the TCE was $18,158, and they were operating just slightly more vessels, about 47 on average.
Got it. And costs? Did we see movement on the operating expenses?
We did. Daily OPEX, it increased by about 6% year over year, came in at $5,765 per day. Compared to $5,442 in Q1 2024.
Okay.
And they also gave a number excluding dry docking and delivery costs. That specific OPEX figure was up by around 10%, $5,456 versus $5,038 last year.
So higher costs, lower rates, clearly a challenging quarter just looking at the numbers. What did management say about the market conditions driving this?
Yeah, they definitely flagged the challenging conditions. They mentioned the usual seasonality. That was part of it.
Sure, Q1 can be seasonally weak.
Right. But also ongoing geopolitical uncertainties and specific concerns about tariffs impacting global trade and growth. So kind of a volatile VIX.
Sounds like it. But even with that volatility, they still took delivery of a new build, number 12, I think.
That's right. Their 12th new build arrived in the quarter, which, points to their longer-term flight strategy.
And that seemed like a big focus on the call, didn't it? Fleet renewal, efficiency.
Absolutely. Laser focus, I'd say. Renewing the fleet, operational efficiency, and environmental performance, especially with the new IMO regulations coming down the pike.
You can really see that in the fleet breakdown now. They have those 12 Phase 3 vessels.
Yeah, the newest ones, built to higher environmental specs, delivered after 2022. Plus, they've upgraded 24 of their existing ships environmentally.
And 11 of those are now classed as eco-vessels.
Correct. Better design efficiencies.
What also jumped out at me was the Japanese-built aspect. 80% of the fleet.
Yeah, that's significant. Way higher than the global average, which is around 40%. And Japanese yards, well, they have a reputation not just for quality, but often for better energy efficiency.
Which is becoming increasingly important.
Crucial, especially with emissions rules tightening. Their overall fleet age is pretty decent too, about 10 years on average.
And they're not stopping there. 6 more Phase 3 ships on order.
Yep, due by the first quarter of 2027. And they made a point of saying these were ordered at prices, quote, significantly below prevailing market rates.
Locking in potentially lower costs. That's smart if prices stay high.
Could be a real advantage. And environmentally, they highlighted achieving a zero carbon intensity, or CI, rating for IMO in 2024.
Okay, that's a strong point. Let's shift to the supply side outlook. What's the picture for the overall dry bulk fleet?
Management's projecting fleet growth around 2.8% per year on average for 2025 and 2026.
Okay.
That includes expected new deliveries, but also factors in an anticipated increase in scrapping, taking older ships out.
And the current order book, how big is that relative to the fleet?
It's sitting around 11% of the current fleet size. Importantly, they noted that the pace of new orders has actually slowed down.
Which usually helps balance supply longer term.
Right. Now, looking at ship values, they expect asset prices might weaken further. Maybe older ships down around 25%, modern ones perhaps 10, 15%.
And secondhand prices tend to follow freight rates, I guess.
That's what they suggested, yeah. If rates are soft, ship values tend to soften too. And they do expect more ships to head for recycling, which would remove some older capacity.
Makes sense.
An interesting point they made was about alternative fuels. While maybe 30% of the total shipping order book across all sectors is alternative fuel capable somehow, the dual fuel order book specifically within dry bulk is, quote, minimal.
Okay. So not many dry bulk ships being ordered can run on methanol or ammonia yet.
Seems that way. Although Safe Bulkers themselves do have 2 dual fuel new builds in that order book, set for Q1 2027 delivery.
So they're dipping their toes in, but it highlights a challenge for the wider industry, especially with, 25% of the current global fleet being over 15 years old?
Exactly. That older segment looks pretty vulnerable as these environmental rules get stricter.
Speaking of rules, MEPC 83 came up. That sounds important.
Very important. The IMO adopted a new global fuel standard. They described it as conceptually similar to the EU fuel regulation.
So what does it do? Penalize emissions?
Essentially, yeah. It penalizes ships for excess fuel carbon intensity against limits that get progressively tighter over time.
Yeah.
And it's global.
Not just regional.
Right. They said it's going to substantially impact how easily vessels can trade from 2028 onwards. It really pushes towards alternative fuels and those energy-efficient Phase 3 ships.
So it accelerates the whole decarbonization push.
Definitely dictates a faster pace for the industry.
Okay, let's pivot to demand. What's the macro picture management is seeing?
Well, they pointed to a couple of big clouds hanging over global growth, ongoing trade friction, tariffs mainly,
right,
and the persistent issues in the Chinese property sector, both adding to uncertainty and risk and also contributing to sort of disinflationary pressures.
And how does that translate to dry bulk demand versus supply?
Their baseline expectation seems to be that supply growth will likely run a bit faster than demand growth.
Which means pressure on freight rates.
Exactly. That's the expected outcome.
What about overall global growth forecast?
They mentioned the IMF's April forecast, projecting around 2.8% global GDP growth for both 2025 and 2026, alongside hopes for inflation gradually coming under control.
And for dry bulk demand specifically?
They cited BIMO forecasts suggesting maybe flat to slightly down in 2025, like -1% to 0% growth.
Oh, okay.
But then picking up a bit in 2026, maybe 1.5% to 2.5% growth.
Yeah.
Within that, grains and minor bulks are seen as the stronger sectors.
Interesting. What about the big players? China's
still complex. Projected GDP growth around 4% for 25-26 is, slower than they've been used to.
Right.
And management sees the property market issues, low consumer confidence, and also more use of recycled steel, really dampening demand for things like iron ore and coal.
And coal's also facing headwinds from renewables.
Yeah, rising renewables in Asia, plus more domestic production in China and India hitting coal imports.
But India itself is a brighter spot.
Seems so. Projected for faster growth, 6.2% GDP increase in 25-26.
Yeah.
Driven by renewables investment, industrial growth, manufacturing, infrastructure.
Okay.
So the expectation is India will be a positive driver for dry bulk demand, especially giving a boost to minor bulk shipments.
So adding it all up, supply probably outpacing demand overall, keeping rates under pressure. And they mentioned Capesize feeling that pressure recently.
Yeah, the Capesize segment was noted as being particularly affected lately by that dynamic.
But this is where Safe Bulkers has a bit of a shield, right? With their Capesize fleet.
Exactly. All 8 of their Capes are currently on period charters, not exposed to that weak spot market.
And those charters are pretty solid.
Very solid. Average remaining duration is 2 years, and the average rate is strong $23,000 per day.
Wow, okay. That provides a lot of visibility.
Huge visibility. It adds up to a contracted revenue backlog of $137 million just from those Capesize vessels alone. That's a significant buffer.
And just for context, that $23,000 Capesize rate compares to what in the current spot market for, say, Panamaxes?
Management mentioned the Panamax spot market was hovering around $11,500. So yeah, that 23K fixed rate looks very attractive right now.
What's the plan for the Capes when those charters end? They have a couple coming up soon.
Yeah, one this month, another around August. Their preference, they said, is actually to trade them on spot voyages unless they can get period rates above $20,000 a day for a couple of years.
Interesting. Okay, shifting to the financial position, liquidity, balance sheet.
Management stressed they're in a strong position. As of early May, they had about $122 million in cash.
Plus credit lines?
Plus $128 million available under committed revolving credit facilities.
Okay, so combined, that's $250 million in liquidity and available capital. Pretty healthy.
Yeah, quite healthy. And on top of that, they have that contracted charter revenue backlog, $179 million in total, non-cancelable period charter revenue.
That's excluding commissions, right?
Excluding commissions. And they also noted there's additional borrowing capacity linked to the 6 new builds as they deliver, plus 1 existing ship that's debt-free.
And leverage levels.
Comfortable, around 37%. And net debt per vessel is relatively low at $8.5 million, especially for a fleet with a 10-year average age.
They also mentioned the scrap value as a sort of floor.
Right. Pointed out their $390 million market cap compared to the $317 million estimated scrap value of the 47 vessels currently on the water, provide some asset backing.
Now, shareholder returns, they've been pretty consistent with dividends.
Very consistent. This was the 14th consecutive quarterly dividend, declared at 5 cents per share. Based on recent prices, that's about a 5.5% yield.
And they've been buying back shares, too.
Yes, they just completed a repurchase program, bought back 3 million common shares, and that was fully used up during Q1 2025.
So dividends and buybacks, how much capital returned recently?
Since 2022, it adds up. $73.6 million in common dividends and another $69 million through common share repurchases. Pretty substantial return to capital.
Did management comment on the stock valuation?
They did, explicitly. They stated they believe the stock is undervalued compared to its net asset value, or NAV.
So they think it's cheap relative to the ships and contracts.
Pretty much. And because of that view, they suggested buybacks might actually be more attractive right now than buying more ships on the secondhand market at current prices.
But they'll be cautious with future buybacks.
Yeah, they signaled caution. The pace will depend on the freight market improving, mainly because they still have those capital commitments for the remaining new builds. Need to balance returning capital with funding growth.
Okay, let's try to pull this all together for you listening. Safe Bulkers got through a weaker Q1, facing those market headwinds, softer rates, uncertainty.
Right, exactly what management described.
But it looks like they're navigating it from a solid base. Strong balance sheet, good liquidity, and that big Capesize charter backlog acting as a nice cushion.
Yeah, that backlog provides significant cash flow visibility against the softer spot market. And their strategy seems very focused on the future.
You mean the fleet modernization?
Exactly. Those eco-friendly Japanese-built ships, the Phase 3 new builds, ordered at good prices. It all seems well-timed for the tougher environmental rules coming, like MEPC 83 kicking in from 2028.
So that could become a real competitive edge.
Could be. And the shareholder returns the steady dividend. The recent buyback signals management's confidence, doesn't it? Confidence in the long-term value, even if they're cautious on buybacks near-term due to market conditions and new build payments.
Right. And the demand outlook remains, well, mixed. China slowing, India growing, minor bulks maybe doing better than iron ore and coal. That mix will shape the rate environment.
Definitely something to watch.
Okay. Now for our segment. Let's call it not financial advice theater. We cook up a couple of wild but maybe plausible trade ideas based only on what we heard from Safe Bulkers update. Pitched like we're talking to an investment committee.
All right, I like it. Trade idea number 1, the regulatory scrappage spread play.
Okay, lay it out.
So, management flags. 25% of the global fleet is old, over 15 years. Asset prices for older ships are expected to drop maybe 25%. Recycling set to increase. And the big one, MEPC 83 hits in 2028, penalizing inefficient ships globally.
Okay, I see where you're going.
The play is to bet on that value gap, widening the gap between old, inefficient ships and modern, eco ones. You could look for companies maybe heavily exposed to that older tonnage, perhaps short them.
The bet being that regulations and market preference for clean ships forces accelerated scrapping or depresses those old ship values much faster than people expect.
Exactly. A compliance crunch creating a value spread.
Interesting. Okay, trade idea number 2.
Idea 2, the undervalued eco new build arbitrage. This one focuses more directly on Safe Bulkers.
Go on.
Management says the stock's undervalued versus NAV. They locked in 6 new builds well below prevailing market prices. Their fleet is already heavily weighted to efficiency, 80% Japanese, 0 CI rating, 12 Phase 3s, 2 dual-fuel ships on order.
So the argument is, go long Safe Bulkers.
Yeah. The argument is the market hasn't fully appreciated the value of this modern, compliant fleet, especially looking ahead to MEPC 83 in 2028.
So the arbitrage is between the current perceived undervaluation, the favorable new build costs they secured, and the future earnings potential of having the right kind of ships when regulations bite.
Precisely. Betting the market eventually recognizes the value of that environmentally advantaged fleet, especially if a 2-tiered market develops where cleaner ships command a premium or simply face fewer trading hurdles.
Got it. 2 interesting, if speculative ideas derived purely from the call.
Purely from the call.
So wrapping up this deep dive, Safe Bulkers weathers a soft Q1 thanks to decent liquidity and that Capesize charter protection. Strategy seems focused on fleet quality and preparing for stricter environmental rules.
Yep, positioning for the future while managing the present. The capital returns show confidence, but the cautious buyback outlook acknowledges the current market and future spending needs.
And just to hammer this home one last time, everything we discussed, especially those trade ideas, is just analysis based only on the Safe Bulkers Q1 update. It is absolutely not financial advice.
Definitely not. Investing carries real risk. Always do your own homework.
We hope this gives you some useful context and things to think about from their latest update.
Yeah, consider these points. Maybe dig deeper yourself.
Thanks for joining us for this deep dive.
We'll catch you on the next one.